Welcome, everybody. This is Steve Gorin. Thank you for attending today's webinar, Final Regulations and Other Recent Guidance under Code Section 199A, Life Insurance Income Tax Developments as well. Before we begin, we want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these questions during the webcast, but if a fuller answer is needed, or if we run out of time, we will answer them later via email or otherwise. A copy of today's slide deck is available in the resource widget. You can also find the PowerPoint for today's webinar with my newsletter on our website, www.thompsoncobra.com. We encourage you to download any resources or links you may find useful. You can find additional answers to some common technical issues located in the help widget at the bottom of your screen. The webinar is CLE accredited in California and Illinois for 1.5 hours of general CLE credit, and in Missouri for 1.8 hours of general CLE credit. We award CLE based on attendance for the entire 90 minutes. From time to time, you will be required to click a pop-up screen to reflect your continued engagement. We value your opinions and appreciate your participation in the course. So, on to our overview. Go on to the next slide. Okay, so even though 199A is really going to be the bulk of what I talk about today, first we're going to talk about some life insurance issues, so then I can just focus on the 199A stuff after that. There's life insurance income tax issues, including proposed regulations under the transfer for value rules, and also a case involving the treatment of compensatory split dollar arrangements. Then we'll talk about the 2019 final regs under Code Section 199A, and there's some additional proposed regs that got issued and other guidance. So we have a full plate today. Okay, on to the next slide. So, reportable policy sale. So, under the 2017 tax law, a new definition came in for reportable policy sale that has some minor and some huge consequences. So, reportable policy sale, you can see here the definition, is acquiring the life insurance contract when the acquirer has no substantial family, business, or financial relationship. So basically, this is geared toward sales of life insurance to third parties. So, indirectly can mean any kind of things you try to do to try to get around this by using business entities or stuff like that. And the proposed regulations describe substantial family, business, or financial relationships. By financial relationship, that would mean, for example, you have a lender, and they want to make sure that for the business, for example, and they want to make sure that if you die, that they'll get paid off on their loan. So that's a relationship that was really independent of the insurance. The insurance is more just helping to help collateralize that. So going on to slide 5. So if you have a reportable policy sale, then generally you're going to have a transfer for value. And we know that, I don't know how much of us know, but the transfer for value rules basically say that if you transfer your policy for consideration, normally that's a sale, but there are things that can be consideration that fall short of a sale. But if you transfer it for consideration, then there's going to be an income tax consequence to that. And that income tax consequence is basically the death benefit is not going to be excluded from income. There is some credit for premiums paid and purchase price, etc. But the bottom line is that the death benefit above and beyond what the new owner has paid for the contract is going to be taxable. So there's the various reporting requirements that apply when the death benefit is paid as well. And then there's a separate code section that deals with that. But I'm just going to talk about the income tax consequences. So let's go on to slide 6. So let's suppose that you're not selling on an open market or some other kind of settlement transaction to a stranger. The government decided to use implementing reportable policy sales as an occasion to revisit and update the regulations under the transfer for value rules. So again, when you have a transfer for value, let's get away for a minute from this reportable policy sale issue and get into just normal business transactions. So a lot of times people will use life insurance to fund buy-sell agreements, and I have a whole separate webinar on that from a couple of years ago. You're welcome to just email me and ask me for that talks about using life insurance in buy-sell agreements. But a lot of times you may be transferring policies around in connection with your business succession planning, and those may have transfer for value consequences. There are some very helpful exceptions to the transfer for value rules. So, like if you transfer it in a substitute basis transaction, and that doesn't trigger transfer for value rules. So, for example, you might contribute your life insurance into a partnership, and that's an income tax-free event, and generally. And so, if it's an income tax-free event, then the transfer for value rules are not going to get triggered. And there are other exceptions to the transfer for value rules as well. If you do have some kind of a transfer for value that's going to taint your policy, conventional wisdom is all you got to do is transfer it back to the insured, and then after the insured does subsequent transfers, then you'll be able to avoid the transfer for value rules. David or Veronica, you're not muted. We need to. You're coughing, so we need to get you off of that. Okay, so so when you have a transfer for value, normally you can cleanse it by transferring it back to the insured, and then the insured does some subsequent transfers, so your policy has been cleansed. That's conventional wisdom. Now, there's a couple of issues here that we need to talk about. So one of them is there is something in the proposed regs that makes it look like that the substituted basis rule, so when you're transferring it in a non-recognition transaction like a transfer to a partnership, the proposed regulations at first glance make it look like that's going to cause transfer for value issues. But an example in the proposed regs clarifies that if you have a policy that's not tainted by transfer for value rules, then doing the substituted basis rule will not taint you. By the way, just for the people who are new to this format, so you see these parentheticals like at the top of the slide, like parentheses 2Q 4B double I. So that's a cross-reference to my materials, and if you have my newsletter up, actually the newsletter has a cross-reference to the materials, and you can click on that cross-reference to my newsletter, and it gets you right into the materials. So anyway, that's where the support for what I'm saying is. So the second thing has to do with what if you do transfer back to the insured, is that going to cleanse the policy of any transfer for value taint? And again, we used to think that almost anything, any type of transfer back to the insured would suffice. However, the proposed regulations say that you can cleanse a transfer for value only if the insured buys the policy for its fair market value. So if you make some kind of a gift to the insured because we don't want to pay income tax on the transfer to the insured. So you're trying to make a gift to the insured or some kind of a non-taxable distribution to the insured. You have to buy for the fair market value according to the proposed regs. So we'll see what happens when that gets finalized. Now, the other thing for that is that if it is a reportable sale, a reportable policy sale, then that will taint the policy forevermore. So if you sell to an unrelated third party, for example, and that's just kind of chugging along, and then you unwind that transaction, and the policy goes back to the insured, that policy will not be cleansed of its transfer for value taint. From then on, the moment that you do the reportable policy sale, that policy is forevermore tainted. So that's it for the reportable policy sale. Now let's go on to a split dollar development. And as far as the split dollar development is concerned, the issue on split dollar is that split dollar, let me go back and define it. Split dollar is an arrangement where you have one or more people paying the premiums and one or more people receiving the benefits. So in split dollar, normally you'll have the employer will pay for the premiums, and then the employee will get any death benefit that exceeds the cash value. That's kind of the normal split dollar nowadays. And so when the employee gets entitled to that death benefit, then generally that employee is considered to receive compensation income on that. Now, let's suppose you have an S corporation and you have somebody who is both a shareholder and an employee. So then the question is, well, what's the nature of the arrangement? So kind of a first glance common sense thing would be that, if this is part of a shareholder type of arrangement, then that would be treated as a distribution. If it's part of the employee benefits package for the person, then that would be treated as compensation. That's kind of what a common sense first glance approach that people would think. But that is not the approach under certain regulations. So the split dollar regulations under 1.61-22 basically say you have to look to the nature of the relationship. But then there's a cross-reference in that that refers back to a corporate distribution regulation. And that corporate distribution regulation says that whenever there's a split dollar arrangement that involves a shareholder, the benefits that go to that shareholder have to be considered to be a distribution from the corporation to the shareholder. So let's suppose you're an S corporation and you put together the split dollar, and it's very clearly part of the shareholder employees benefits package. So the Sixth Circuit Court of Appeals ruled, I don't care if it's compensatory. The regulation says whenever a shareholder is involved, it's got to be a distribution. And the split dollar regs cross-reference that regulation. So the fact that this deals with the shareholder, that supersedes all other factors. So there may be a number of people who have split dollar arrangements in place with employee shareholders who've been adding them to their W-2 wages. And that treatment according to the Sixth Circuit, is incorrect. And I mean, when I read the Sixth Circuit opinion, I went back and looked at the regulation. It seems to me the Sixth Circuit is probably right. I think that people ought to be treating those as distributions to the shareholders. Now, if you are an S corporation, so now we have these distributions that we didn't know that we had, is that going to mess things up? An S corporation has to have a single class of stock. And the single class of stock means that every single share has to be entitled to the same level of distributions as every other share that's owned. And so what if you have one particular shareholder who's deemed to receive a distribution from the split dollar, and the other shareholders don't get that? So then that shareholder is getting extra distributions. So will that violate the second class of stock rules? And the answer is no, they won't violate it. And my materials go through why it isn't. There's an exception in the rules for things relating to your employment and other types of matters. The split dollar agreement is not part of your articles of incorporation, and that's really key to the whole thing. So there is not a violation of the second class of stock rules, but you should clean it up so that everybody gets proportionate distributions. Now, what happens if people say, hey, that's not what we really bargained for. We meant this to be compensatory, and it got treated as a distribution. That's not really fair. Now it's going to reduce the distributions that we get. Well, then perhaps the fairness thing means that the person is being undercompensated. So maybe this person should get more compensation for the work they're doing. So that's the bottom line, is that just give them cash compensation and recognize the split dollar agreement for what the regulations require it to be. So that's all I have for the life insurance, and I don't see any questions on that yet. So I'm going to move on to the next slide and get into what a lot of people might be considering to be the main event. The regulations under Code Section 199, capital A, the deduction is up to 20% of qualified business income. And I've gone through this before. We have a couple of other presentations I've done. You're welcome to go back and look at it. I'm not going to go through all of the details of the deduction, but I'm just going to hit some highlights. So let's go on to the next slide. And I just wanted to point out that there's here's a bunch of guidance in 2018 and 2019, and these are live links. So if you open up the slides, you can click on them and go there. The final regulations were released by the IRS, by the government in January, and became officially issued in February of 2019. And there was a comment period that ended about 2 weeks ago. So the comment period is up on that. But I'm going to go through some changes to the final regs. I'm going to go through some new proposed regulations that they issued in 2019, as well as there's a 2019 notice on a real estate safe harbor. I'm going to go over that too. You can see the last link is AgTech comments, and that's something you want to make a note of slide 9. I don't remember. I might have a link later on in it, but you're going to want to go back to that link when it comes to the multiple trust rules when I go over those. Okay, so let's go on and let's keep forwarding the slides through 10, 11, 12, slide 13. So slide 13 you may recall, so we have our deduction, which is 20% of qualified business income. But if your taxable income is above certain thresholds, then that limitation, that deduction, the 20% of qualified business income, is limited. It's limited. It cannot exceed the greater of 50% of the W-2 wages or the sum of 25% of the W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition of the qualified property. You may remember that unadjusted basis immediately after acquisition is UBIA. For those of you who haven't heard me say this before, those of you who've watched the movie Die Hard, don't get UBIA mixed up with Yippee-ki-yay from the movie Die Hard, but the words that follow Yippee-ki-yay do describe the complexity of the tax law. But so anyway, there's this limitation that's based on your original cost of qualified property. And I'm not going to go through all the details of how that works, but there are some circumstances where the UBIA might be adjusted. And I'm going to go through those. So let's skip through slide 14. I just point out the RevProc implements the regulations, and the regulations provide relief for leasing employees, but using independent contractor still doesn't help. Okay, slide 15, those are the requirements for being qualified property. Slide 16 talks more just about it. Slide 17. So normally, when you form a partnership or a C corporation, those events are non-taxable events. And whenever you transfer your property into those, in this non-taxable event, the property's basis stays the same. So whatever your basis was before you contributed it to the partnership or corporation, the basis stays the same. Now, the proposed regulations would have changed the UBIA. So, for example, suppose you bought a piece of equipment for $1 million and you wrote it off in the first year, as bonus depreciation allows you to do, so it has zero basis. Under the proposed regulations, if you kept that $1 million piece of equipment out of your new entity, you get UBIA of $1 million. But if you contribute it to your new entity, then the UBIA would change to the basis on the time you formed that entity and would have been reduced to zero. Well, you can imagine how that would have complicated people doing business. You would have had artificial incentive not to contribute the property used in your business to the business. Instead, you'd maybe want to lease it or something like that. So that was a ridiculous proposed regulation. I chaired ACTEC's efforts to make comments on these. This is one of the things we criticized, and the final regulations agreed with us. They eliminated that change. So if you have your $1 million piece of equipment that you wrote off fully and you contribute it to your new partnership or your new S-Corp, the UBIA will continue to be $1 million when you contribute it to that entity. Going on to slide 18. So now let's talk about partnership and outside basis and inside basis. And I know a lot of you know this already, but I just want to go back to the basics and make sure that everybody's on the same page. So let's suppose I die holding my fully depreciated property. Then my beneficiaries are going to get a new basis equal to the value of that property, so they get a basis step up at death. And the regulations say that the proposed regs and the final regs say that your UBIA would change as well. Now, let's suppose that I had an S corporation, and that S corporation had $1 million worth of land, and that $1 million land was purchased many years ago so far we don't even have basis records, so let's just say it has a 0 basis. So let's suppose that I had $1 million in my S corp, and I sold half of my S corp stock to Irene. Now Irene buys it from me for $500,000 because she thinks that land is worth that every penny of it, and thinks there's great prospects for future growth. And there's other elements of the business too that make it really great for future growth. So Irene has a $500,000 basis in her stock, but because it's an S corp, the basis of the land doesn't change; it's still 0. So maybe next year we decide, the business that we're running really would be better done with a different piece of land, or maybe even something else. Maybe we're not even going to have land. Maybe we're going to sell the land and buy equipment and get into equipment leasing. So we sell the land, and the S corp will have $1 million of gain, and that $1 million of gain is divided between Irene and me on K1s, and I get a K1 for $500,000 gain, and Irene gets a K1 for $500,000 gain. But wait, Irene paid $500,000 for her stock. She has paid for that gain. The tax law says, that's all well and good, Irene. You have to pay the tax on the $500,000 because the basis of the land didn't change. Now, your basis and your stock is going to be $1 million. The $500,000 you originally paid for it, plus the $500,000 of gain that you're paying tax on. So Irene's going to be sitting here with $1 million worth of basis for something worth $500,000. Irene isn't going to be happy with paying tax on that $500,000 gain. S corps are not very good for that, at least to that extent. Now, if we had a partnership instead, then when Irene bought my partnership interest for $500,000, we could have made what's called a Code Section 754 election, and her half of the land would get a new basis. The $500,000 she invested, that would pass through, and as far as Irene is concerned, her half of that land has a $500,000 basis. And when that land gets sold, then Irene is not going to have to report a gain on that. So there's what we call an inside basis adjustment. So the question is, if you have an inside basis adjustment like this, does that carry through to be UBIA? Now, the proposed regulation originally said, no, it does not. I'm going to run you through an example here, and look at the third bullet point. So in our example, suppose the original purchase price was $100,000, and that's the current value. So, and then over the years, we've had accumulated depreciation of $40,000. So we've had $40,000 of depreciation deductions, and when we subtract those $40,000 of accumulated depreciation from the $100,000 original purchase price, we now have an adjusted basis of $60,000. So let's suppose again that there's some kind of a sale of a partnership interest, and that there's a basis adjustment as a result of the 754 election, and so there's a $40,000 basis adjustment. So basically, that accumulated depreciation got wiped out as far as this new partner is concerned. So, do you get new UBIA for that basis adjustment? The answer is no. The old UBIA was $100,000. The depreciation did not reduce the UBIA. The whole point of UBIA is it's the original purchase price without considering depreciation. So, if we took $100,000 of the old UBIA and added the $40,000 inside basis, that adjustment, that would be $140,000. But the property is only worth $100,000. the sale of the partnership interest was based on a $100,000 value. The UBIA needs to stay the same at $100,000. So, in this case, there would be no UBIA adjustment. Now, let's change the facts a little and have the value increasing to $125,000. So the $125,000 is $25,000 more than the original purchase price. So, because it's $25,000 more than the original purchase price, that needs to be our UBIA adjustment. Now, here's how I go through the math. So the basis adjustment, the inside basis adjustment for regular income tax purposes is going to be $65,000. The $125,000 based on this new purchase minus the $60,000 accumulated depreciation. But the UBIA adjustment is only $25,000 because that's the amount by which the $125,000 deemed purchase price exceeds the $100,000. So, going back to the top of the slide, so the 754 election is causing an inside basis change, and what I gave you an example is what's called a 743B election. 743 is when you transfer your partnership interest in some manner that qualifies, then you can get the inside basis adjustment. Normally, that's like death or some kind of sale or exchange of the partnership interest. Now, there's another type of inside basis adjustment that might apply, and look at the very bottom bullet point. That's a 734B adjustment. So sometimes, if you distribute property out of the partnership, and that somehow reduces the basis the property got distributed, which is very possible, then the basis of the property inside the partnership would go up if the 754 election is in place. And so that's a 734B adjustment. And those do not get a change in UBIA according to the final regulations. So the 754 election, there was very significant relief from an estate planner's viewpoint. You know, the vast majority of the time, we're going to see the transfer of the partnership interest, and so this is going to affect our clients. Okay, so that's the end of slide 18. Slide 19, you have to be a qualified trade or business. Slide 20. Within an entity, you might want to combine or separate various activities depending on how their qualified business income, W-2 wages, and UBIA relate to each other. And you might want to combine or separate them depending on whether they can be aggregated or segregated. And delineating businesses can be very important. And I'm going to talk about some of that importance a little bit later. But again, the fundamental unit of component of 199A is each business. So what is a separate business? So look on slide 21. The preamble of the final regulations refers to a regulation that relates to accounting periods. Accounting methods. And here are the bullet points here that says what it needs to be in order to have a different accounting method within your entity for a different business. So, like, if you have one, suppose you have one S corporation, and that S corporation, has a manufacturing facility and a movie theater. Okay? Those are pretty obviously separate businesses. And so you could have different accounting methods for those businesses. And similarly, they would be separate businesses for 199A. Now, if we want to separate our businesses, which we very well may want to do, Then, if you look at the second bullet point, you need to keep a complete and separable set of books and records. So, separable doesn't necessarily mean separate. You could have one set of books and records for all of your businesses, and they still might be separable if you can pull apart the components of that business, and you could still possibly qualify. Now, even though the regulations allow you to do that, I do not recommend it. From the standpoint of preparing your books and records, for being able to do internal management accounting, just to see how each business is doing, and compiling that for your owners, your lenders, and the other stakeholders, and your tax returns. You really should keep them separate, just as a matter of good business practice. In fact, I go as far as to say I think you should have a separate bank account, at least one separate bank account for each business. And that way, when you run your receipts through those bank accounts, you know which business they relate to. And then when you go to figure out your activity for that business, you know you can focus on that particular bank account. Very helpful for auditors, etc. Now, of course, if I'm going to have a movie theater and a manufacturing subsidiary, I'm going to probably have those in separate LLCs. We're going to talk about that in a little bit. So even though the regulations allow you to be separable, I strongly recommend that you keep everything separate. Okay, slide 22. That's the regulation that basically talks about if you have multiple businesses, then you can use any reasonable method to allocate between your income and expenses. Slide 23. Now, they didn't tell us what a separate business is other than referring to the regulations. But there is an analogy that you might want to draw. Since they're not telling us what to use, there is another area where they are telling us something that's a safe harbor. So if you have tax-exempt entities, then tax-exempt entities need to separate out their businesses. And that relates to their ability to deduct losses from business activities. And so the IRS has this notice, 2018-67, that says if you want to try to separate out your businesses, here's a safe harbor. You can look at these 6-digit codes, and I have the cross-references here. Now, I'm not saying that you're entitled to use this 499A. What I'm just saying is that this might be an analogy that you might consider using. There's nothing that directly ties this in. This is just kind of, if I'm looking for a reasonable good faith interpretation, then this may be one area I might go to as a reasonable good faith interpretation. Okay, slide 24. So each partnership or S corporation needs to determine whether it is engaged in one or more businesses and whether that's a specified service trader business, an evil business that might not get the deduction, and qualified business income, W-2, UBIA, etc. So each partnership, each S corp must determine all of the above and separately report these businesses to the shareholders, to the owners, generally. I'm going to get to an exception in a moment. Slide 25. You can do something called aggregation. So if you have businesses that they have maybe a lot of qualified business income, but it doesn't have a lot of wages and UBIA, maybe you have another business that has a ton of wages and UBIA, more than it needs for its qualified business income. So you would like to be able to take those two separate businesses and add together the qualified business income and the W-2 wages and the UBIA so that the excess wages from one business can be used to help get the deduction, the 20% deduction for the other business. So that's called aggregation. So let's go on to slide 26. So aggregation can be done at the individual, the trust or estate, or the RPE level. That's something that's new under the final regulations. They added in that each partnership or S corp can make its own aggregation election. We're going to go through that in a moment. Now, aggregation does not change the tax character of transactions between the businesses that are being aggregated. All it does is just let you add up the QBI, W-2, and UBIA. Let's go on to slide 27 and talk about the consequences of a partnership or an S corporation electing aggregation. So here's an example straight from the regulations. Partnership number 1 directly operates a food service trade or business. Partnership 1 also owns 60% of Partnership 2. Partnership 2 has 2 different businesses. One is a movie theater, and another is food service. Now, the Partnership 2's movie theater and Partnership 2's food service, they are closely enough related that they could qualify for aggregation. Now, Partnership 1's and Partnership 2's food service businesses also are close enough that generally you could aggregate them. However, going on to slide 28, the food service from Partnership 1 is not related to the movie theater business of Partnership 2. Those can never be aggregated. Now, let's suppose that Partnership 2 decides to aggregate its food service business. Partnership 2 decides to aggregate its food service business with its movie theater business. So now we have Partnership 2's things are all one lump, the food service and the movie theater. Partnership 1 is no longer allowed to aggregate because Partnership 1's food service business cannot be aggregated with Partnership 2's movie theater business. They don't relate to each other enough. So what happens is that there's an anti-bootstrapping thing that says that because Partnership 1's food service business can never be aggregated with Partnership 2's movie theater business, because those two can't get aggregated, if Partnership 2 aggregates its movie theater and its food service business together, then those businesses cannot be aggregated with Partnership 1's food service business. So what's happened is Partnership 2's aggregation of the two businesses prevents the aggregation of Partnership 2's food service with Partnership 1's food service. So what seems like something convenient has actually cut off an option. Now, if Partnership 2 had not made any kind of aggregation election, then the owners of Partnership 1 could have chosen each owner of Partnership 1 could have separately made the decision, do I want to aggregate the two food services together? Or do I want to aggregate the movie theater with the food service from Partnership 2? They could have made those decisions. Or they could have decided not to aggregate them at all. So the maximum flexibility is kept open if you don't aggregate. So slide 29. So therefore, an RPE should not aggregate unless its owners cannot benefit from different mixing and matching of the RPE's various businesses with their own businesses. So instead, the RPE should provide its owners all the information they need to do the aggregation and the ownership information to enable them to determine whether they can aggregate. So the idea here is that you should have centralized production of information, but the RPE should then give that information to the owners and let them make their own decisions. Now, that's kind of a theoretical thing. There may be some practical times when you might want to do the aggregation of the RP level anyway. And I'm going to go through an example. You can see the last bullet point on slide 29. I make the point, aggregating horizontally is more beneficial than aggregating vertically. So horizontally, I mean various businesses within the same RPE. So in the example from the regulations, a horizontal aggregation would be Partnership 2's movie theater together with Partnership 2's food service business. So those are different businesses within the same RPE. A vertical aggregation is the same business spread among various RPEs. So that would have been Partnership 1's food service being aggregated with Partnership 2's food service. That would be vertical. So I think that in many cases you will find that aggregating horizontally is going to be more beneficial than aggregating vertically. And slide 30, we start talking about that. So in slide 30, suppose you have a group of owners that owns parent 1 and parent 2. Parent 1 has a manufacturing subsidiary and a real estate subsidiary. So guess what? The real estate subsidiary leases its real estate to the manufacturing subsidiary. Similarly, parent 2 has a manufacturing subsidiary and a real estate subsidiary. And again, the real estate subsidiary for parent 2 leases its real estate to the manufacturing subsidiary for parent 2. So now the first parent's manufacturing operations are totally unrelated to the real estate used in the second parent's operations. And similarly, the second parent's operations are totally separate than the real estate used in the first parent's. So they could never be aggregated together. So if M1 chooses to aggregate, then that's going to cut off the ability of the manufacturing subsidiaries to aggregate with each other and the real estate subsidiaries to aggregate with each other. So at first blush, you might say, well, gee, I don't want to have some kind of cutoff of this ability to vertically aggregate. But that doesn't really tell the whole story necessarily. Let's look at the fourth bullet point. So each manufacturing subsidiary relies heavily on labor and has wages well in excess of what's needed to maximize the 199A deduction relating to its QBI. And so they want to share their excess wages with their real estate. So M1 might aggregate with R1, and that will give R1 some wages in UBIA to get the deduction with respect to R1's activities. Similarly, M2's if M2's operations are aggregated with R2's, then the M2's wages can help R2's real estate operations get a deduction. So this horizontal aggregation, parent 1 aggregating its operations with each other, and parent 2 aggregating its operations with each other, would be very beneficial. Let's go on to slide 31. So this horizontal aggregation would again prevent the manufacturing subsidiaries from aggregating with each other. But you know what? They don't need to aggregate with each other. M1 and M2 each have ample wages. They don't need each other's wages because they have the same business model. They're manufacturing. They don't need each other's wages. So under no circumstances would it be beneficial for M1 and M2 to be aggregated with each other. Similarly, the two rental properties, neither one of them has W2 and UBI worth speaking of. Aggregating them with each other would be totally pointless. Nobody has an excess wages to help out the other one. So it would be totally pointless. So in this case, it may very well make sense for parent 1 to aggregate its operations and parent 2 to aggregate its operations. Now, the owners might not necessarily agree with that. If they have other operations, maybe they have other manufacturing operations that might be able to be aggregated with the manufacturing, or maybe it's not even manufacturing, just some other obligations. Maybe some operations that are like supply chain. So maybe they're supplying a bunch of intellectual property to the manufacturers, and they service that intellectual property. And there's just very modest wages, and what they're really supplying is, the licensing of that stuff. Then maybe those that are totally outside of this ownership chain, they may be owned by similar owners, but they're doing different things. So maybe there's something that the management of parent 1 and parent 2 don't know. And so there may be possibilities that there's other things that could have been aggregated with the manufacturing, or other things that could have been aggregated with the real estate that maybe the owners of parent 1 and parent 2 don't know about. I'm sorry, the management of parent 1 and parent 2 don't know about. So even though it looks at first blush that it's a pretty much no-brainer that parent 1 and parent 2 should aggregate, there's always a possibility that maybe they shouldn't. So it would just be a good idea for people to talk to each other. So on slide 31, the last bullet point, so if the members, if the owners of these parents if they have other business activities that they think might be related to in some way these M1 and M2, the parent 1 and parent 2, then they should talk to the management of parent 1 and parent 2 and let them know about that. Slide 32, similarly, parent 1 and parent 2, before they aggregate, they should look to see, ask their owners, do you have outside activities that you think should be aggregated? And so that would be a good thing to do. It's ultimately a judgment call. As a practical matter, when in doubt, don't aggregate, because the management can prepare the aggregation statements that each tax return preparers can just tweak as needed and attach. So, again, when in doubt, don't aggregate, but only if everybody is on board. That's generally my rule of thumb. But again, even though I said only, I can't say that there's one rule that applies to everybody. So there's always exceptions. So I'm not trying to say that there's one answer. I'm just saying just think it through really carefully. Slide 33. Totally different idea now, although it does relate to aggregation in some manner. You can aggregate separate businesses, but first you have to determine that they're a business. They might not rise to the level of a business. So, for example, let's suppose that you have 20 different properties that are rented on a triple net lease. Let's suppose each property is in a separate partnership. Each partnership is an RPE. and each partnership needs to determine whether its own activities rise to the level of a trade or business. And each partnership has to put blinders on. Now, see, in the passive loss rules under Code Section 469, a real estate developer can just add up all the activities across all entities and then see whether they've met their tests. Not so with 199A. Each partnership has to, or S corp, has to separately determine whether what it does rises to the level of a business. So now let's suppose you have 20 different activities going on, and you don't know whether they rise to the level of a trade or business. Well, consider, instead of having them in separate partnerships, taking those partnerships and fold them into one master partnership with LLC subsidiaries. So instead of having 20 different real estate LLCs, each of which files its own tax return, you take those 20 LLCs, put them under one parent, and those LLCs are 100% owned by that one parent. Now those 20 separate LLC subsidiaries are disregarded entities. And the final regulations and the preambles made it very clear that you get to disregard those LLCs. So even though they have separate checking accounts or separate legal entities, those LLC subsidiaries, because they're disregarded entities, they are counted as owned directly by the parent. And you can add up everything that those LLCs do to determine whether or not you have a trade or business. So that's a lesson for slide 33. Slide 34, if you aggregate, then you have to have sufficient common ownership, and you can see that there's a reference here to Code Sections 267B and 707B attribution. And the final regulations clarify that they said directly or indirectly under the proposed regs, and what they really meant was the indirect really just referred to this attribution here by 267B or 707B. So basically, if those apply, then you can attribute the ownership. And in a webinar on April 4th that I did for the ABA Real Property Trust and Estate Law section, we had a couple of government representatives, and they said that their interpretation is that when it says 267B, if you look at Code Section 267, actually Code Section 267C says here's rules that apply that you use when you apply 267B. So I asked the government, when you say 267B, do you mean everything that interprets 267B, including 267C? And they said yes. All attribution that you do in figuring out 267B, that all applies. And I think a plain reading will get you there. So I think you need to assume that what the government said on that webinar is correct. I don't know. I can't tell you 100% for sure it's correct, but if I'm preparing a tax return, then I would probably go ahead and assume it's correct. Okay, slide 35 is more in the ownership rules. I'm going to kind of skip through slide 35, slide 36, slide 37, slide 38. Slide 39 talks about a three-part test. If you meet 2 out of the 3 factors, then they're closely tied enough that they can aggregate. And I'm not going to go through those. They're in the slides, the material. So slide 40 illustrates some things. Slide 41 illustrates some things. So I'm going to skip through all of those. Slide 42. So what is qualified business income? It does not include compensation for services rendered. So, for example, Suppose an S corporation pays salary to an employee shareholder. The W-2 wages are not qualified business income to that employee shareholder. Only the K-1 income is qualified business income. Now, the S corp can use those W-2 wages when it comes to computing the W-2 wages for the wage limitation. So those W-2 wages are good in helping you satisfy your wage limitation, but they're bad in that they reduce the K-1 income, and so they reduce the income that's eligible for QBI. If you have a payment, if a partner enters into a contractual arrangement with a partnership, like provide services to the partnership, then and receives some payment for that. Ordinarily, that might have been a business, but because it's received from the partnership to a partner, those payments are going to be what we call 707C payments or 707A payments, and those do not qualify. So go to slide 43. For example, a management company manages many properties throughout the metropolitan region. Normally, the management fee would be qualified business income. But if that management company becomes a partner in the real estate LLC, then that income is now that 707A or 707C stuff on the prior slide, and it's disqualified. So if you provide services to a partnership and you're not a partner, then you get QBI. If you provide services to a partnership and you are a partner, then it's not QBI. I believe that that's unfair, but that's basically what the government read into it from the law, and I can't say that they're wrong about it. I don't think it should be the rule, but I can't say that they're unreasonable in doing that. So I think we're stuck with that. So if you're a real estate management company, then try to get out of being a direct owner of a real estate partnership that you manage. Slide 44, specified service trades or businesses. So these are evil businesses, and you don't get the deduction, the 20% deduction, unless your taxable income is below a certain threshold. Let's go on to slide 45. There is a de minimis rule, and I have to be honest, the first time I looked at this, I kind of overlooked it. And then when I was listening to some recordings from the ABA tax fall meeting, and I heard some speakers talking about this rule, they opened my eyes. So this de minimis rule, at first it sounds, hey, this is kind of neat. If your evil receipts are less than 5 or 10% of your gross receipts, then you get to ignore them. So that's really nice. That's helpful. But the corollary to that is a real snake in the grass. So let's suppose you have a business and 79% of its receipts are good. They're not from a specified service trade or business. And 21% of them are evil. They're from an SSTB. So, under the regulations, that 21% of evil receipts will taint the entire business. So, the evil tail is wagging the dog. And you know, a lot of people complain about it. They think that that's unfair. And I do tend to agree with them. But under that first bullet point, look at that last dash. Here's the key. When I talked about the multiple trader businesses earlier, and I said we'd come back to it. So, if you have a different business, then you consider only the evil receipts from that business. So let's suppose that you have an LLC, and it conducts 3 or 4 different businesses. And one of those businesses has evil receipts, but the other 2 don't. So only the business that has evil receipts will be tainted. the other two businesses won't be tainted. So this is when you want to go and try to segregate things out. You would like to take those evil receipts and establish that they are a separate business from everything else. And that way they won't taint the other ones. So that's when you want to go back to those multiple trades or businesses and think about that. Now, next slide, services or property provided to an SSTB. So this was an what they call a crack and pack rule. And I'm not really going to spend a lot of time going through that. They did change the paradigm a little bit on this, but I'll let you just go through the rules and read them for yourself. Let's see. So I'm going to skip over. Let's see, slide 47. But although they did have some clarifications in the new proposed regs on some of this. Slide 48, I'm going to skip that. Slide 49, I'll skip that. Slide 50, skip that. Slide 51 kind of illustrates the difference between an S corp and a partnership. Sometimes a partnership might convert to be an S corp so you get more wages, but there's pros and cons to it. And if you just read through my materials, the 2E1D, you'll get more of a feeling for it. Slide 52, getting to real estate. So, what is a trade or business? Well, the final regulations do have, in the preamble, they did put forth a list of factors. They did continue to take the approach that a trade or business is like pornography. I know it when I see it. So they did do that, but they went ahead and gave us a safe harbor, which we're going to get to in a moment. But you can still see it. The very last bullet point, the second bullet point, the very last item, Roman at 5, whether it's a triple net lease or a traditional lease. We're going to talk about that in a moment. And we'll also talk about whether you might consider moving vendors and employees. But first, we're going to talk about the safe harbor. So go to slide 53. If you have self-rental, then you're deemed to be a business. So if you're rented to a business that is conducted by another pass-through entity and you have sufficiently common ownership, then your rental activity is considered to be a trade or business, no matter how much or how little you do. So you can have a triple net lease that the IRS would normally say, oh, that's not a business, and you say, oh, it's self-rental, I win. And that's true. Now, notice that rental to a C corporation does not qualify. And that's something that the government wanted to make sure we brought out in our webinar. So let's go on to slide 54. There is a safe harbor, and the IRS is going to put out a revenue procedure that is going to give you a safe harbor. Notice 2019-7 basically said, here is the revenue procedure. Here's an outline of the revenue procedure that we're proposing. We're not adopting this revenue procedure yet as our kind of final revenue procedure rule, but you are allowed to rely on it now if you want. And we're going to give you some more clarification on it but when we finalize it. So basically on slide 54, here's the rules to be in the safe harbor. You have to have separate books and records for your real estate enterprises compared to the other activities you do. You have to spend, at least 250 hours on doing qualified work for your real estate enterprise, you're not excluded, and you have to make a statement on the return. We're going to go through some details. So slide 55, there's the 250-hour rule. Notice the third bullet point, contemporaneous records are required. Under the passive loss rules under Code Section 469, contemporaneous records were strongly encouraged, but they weren't required. They are required under the real estate safe harbor. Go to the next slide, slide 56. A real estate enterprise. Again, it could consist of an interest in multiple properties, and if you have single-member LLCs, those all get mushed together. So, if you're going to add up your 250 hours, suppose you had 10 different real estate LLCs, and you do 25 hours of work for each one of them. If each real estate LLC is taxed as a separate partnership, too bad, you have only 25 hours. You're not within the safe harbor. You might be able to meet it outside of the safe harbor, but you won't be within the safe harbor. Now, if those 10 LLCs are single-member LLCs, all under one partnership umbrella, then you can add them all up together to get your 250 hours. And in our April 4th webinar, the government representatives had no hesitation in saying that that is what you would do. All right, going to slide 57. Here are rental services that are good services that you can count. Slide 58. You do want to try to maximize the services that you do to get you 250 hours, but I just want to warn you, if you start doing things that traditional landlords don't do, those activities may be subject to self-employment tax. They don't taint the rest of it and make it subject to self-employment tax, just those extra activities. But I'm not really concerned about it generally, but somebody did ask me that question and in a prior webinar, so here's the answer. I have a cross-reference to when your work in real estate might rise to the level of being self-employment. But normally I wouldn't worry about it. Normal landlord-tenant stuff, you don't have to worry about it. Daily maid service, that would be a different thing. Slide 59. Here are things that you can't count toward your 250 hours. Slide 60. If you use the real estate as your residence, you don't get to be within the safe harbor. If you have a triple net lease, you can't use a safe harbor. But what does it mean to be a triple net lease? It says that the tenant or lessee must pay would pay for taxes, fees, and insurance, and the tenant would be responsible for maintenance. So does that mean that if the tenant pays for the maintenance, but the landlord provides those services, the landlord is responsible for the maintenance, and therefore it's not a triple net lease? That would be my guess, but I don't know. And when we had our April 4th webinar, basically the government was in the stage of we are learning and listening. They put out the notice to get comments. They have received lots of comments on asking for clarification on the triple net lease. So whatever this is here on the second bullet point here, this is it's not going to look exactly like this on the final go round. When they issue the revenue procedure, they plan to be more specific on what a triple net lease is. Okay, slide 61. You need to file a statement. You have to sign the statement. So if you electronically file, the government told us you need to, informally, the government told us that you need to simply sign your statement and put it as a PDF that gets attached to your electronic statement. Slide 62. Suppose you're not deemed to be a business because of the self-rental. Suppose you're not within the real estate safe harbor, and you're not really sure whether you're a business or not when you're doing the real estate. So maybe the tenant might stop doing the work and the landlord would do the work and get reimbursed by the tenant. You may or may not want to do that. Slide 62 talks about various considerations on that. Slide 63, aggregation. As I mentioned earlier in aggregation, there's a three-factor test, and you needed to satisfy two of those factors in order to be able to aggregate. So can you aggregate real estate? Well, the first bullet point There's a helpful example that says that there's commercial rental in separate states. Like maybe one is in Missouri and another one is in California. And they have centralized management, centralized payroll, centralized collections. They all use the same, services or whatever. They may aggregate because they basically are being offered together. Kind of the same commercial real estate is kind of the same type of business, and so they could aggregate. Now, if you have residential condo and commercial rental, residential and commercial are considered to be different things. Now, you could still meet the 2 out of 3 factors test, but my point is that the IRS is going to look a lot more closely as to whether you meet the 2 out of 3 test if you're commercial and residential, you're trying to aggregate. Whereas if it's commercial with commercial, you're likely to be able to aggregate. So slide 63 at the very bottom, the residential condo and residential apartment, that sounds the same. I mean, also picture what if you had, suppose you had, like in downtown St. Louis, we have on the first floor there's retail, and on the higher floors there's residential, there's lofts. Could you aggregate those things together? Well, perhaps not. But they're at the same location. They may have the same people supplying them. They may have the same people even kind of looking after the property totally. So they might, even though they're separate businesses, that's the whole point. They're separate businesses. They could still maybe be aggregated. Okay, so that's it on the real estate. And I don't see any questions yet. I really do encourage people to ask questions in our little questions widget that's at the bottom of your screen. So let's go on to slide 64. So trusts and estates. So there's some things they kept the same, some things they changed between the proposed and the final. The grantor trusts are disregarded and their items attributed to the deemed owners, that stayed the same. If you have a non-grantor trust or you have an estate and you keep some of the income, distribute part of it, then you prorate the QBI, UBIA, and W-2, depending on your respective shares of distributable net income. Let's go to slide 65. So remember I talked about those taxable income thresholds. So if your taxable income is too high, then you can't get a deduction for your activities from your EVO businesses, your specified service trader business. And also, if your income is too high, then you're subjected to the wage and UBIA limitation. So how you determine your taxable income threshold is very important because it can determine whether you get a deduction or not. Or if you get a deduction, it can determine the size of the deduction. So how do you compute your threshold? The proposed regulation said that when you have your income distribution deduction from your trust, so let's suppose you had a trust at $300,000 of distributable net income, it kept $150, and it distributed $150, so it wound up having taxable income of $150. Well, the proposed reg said, no, we're not going to give you credit for that $150 going out to the beneficiary. We're going to look at your tax at your $300,000 distributable net income, and we're going to nail you on that. Actually, it's the taxable income before the distribution reduction, technically. That's what they were going to do. And our ACTAC task force complained about that, and we believe that it didn't have any basis in the law, and the final regulations agreed. So when you distribute your income out to the beneficiary, so you each have 150 taxable income, that's all that counts toward your threshold normally. Let's go to slide 66. If you have an electing small business trust, so an electing small business trust is a type of trust that can hold stock in an S corporation, and even though for all purposes of income taxes, every single purpose of income tax, the S corporation portion is taxed totally separately than all of the trust other income, totally separately for all income tax purposes. Notwithstanding that, the regulations say that you have to add together your taxable income from both portions in determining your taxable income thresholds. So I disagree with this rule, but it's in the final regs, and we're stuck with it. Okay, slide 67. I'm going to skip over that. And 68, I'm going to skip over that. Slide 69, skip over that. So slide 70. So there's an anti-abuse rule and relating to trust and code section 199A deduction. So the proposed regs basically said when you put together your trust, if you even talk about income taxes, then you're toast. You have an abusive trust. This is an evil trust, and we are going to disrespect that as a separate trust, as a separate entity, for all purposes. So, AgTech, we pushed back on two different comments. We said, first of all, just talking about taxes, give me a break. Whenever you do anything in our society, you have to think about the tax consequences. Principal purpose should be the test, just like the multiple trust rule. And if you go and look at some of the tax law where they say a principal purpose anywhere else, that means the purpose that's the most important one. Doesn't have to be the overwhelming one. It just needs to be greater than any other one particular purpose. And the government relented. They went back to say, okay, we're going to use the principal purpose test instead of, they were saying a significant purpose. And the other thing is they said, we're not going to respect the trust. And so we pushed back. We said, look, the abuse you're targeting here is the taxable income threshold, that you're creating multiple trusts that you can kind of split up your income and then you can get below the threshold. That's what the abuse would be. That's the only thing that this abuse should apply to, is the taxable income thresholds. And the IRS agreed with us. So here's the regulation on slide 70. It was narrowly changed to a principal purpose instead of significant, and will not be respected as a separate trust for purposes of determining the threshold. So notice the passive voice used here. A trust will not be respected. What does it mean it will not be respected? AgTech fellow Mickey Davis said, is this a Rodney Dangerfield trust? Don't get no respect. Slide 70, if you look at the bottom of the preamble of the proposed regs, if a trust creation violates the rule, it will be aggregated with the grantor or other trust from which it was funded for purposes of the threshold amount. What's the effect of this on the grantor, the trust, and the beneficiaries? So look on slide 71. Example. Mom is married, has $400,000 of qualified business income from an SSTB, so it's an evil business. So if she's above the taxable income threshold, she doesn't get a deduction. She has $400,000 of QBI and $100,000 of other taxable income, so she has a total combined taxable income of $500,000. she's phased out, no deduction. So she would like to get this deduction, and she says, I'm going to give half of the business to son. So now mom has only $200,000 of the QBI, half of the 400. So 400 times a half is $200,000. Plus she has $100,000 of their taxable income. So her taxable income is $300,000. So she's below the threshold. Son, he's married. He has $200,000 of taxable income. He's below the threshold. Now they both get the deduction. She did this mainly for tax reasons, but this is totally respected because she gave it to him outright. Now, there's other consequences. I mean, mom is not getting that other $200,000. Son gets it. So that really can't be, taxes can't be the only reason. I mean, she actually wanted to have son have the money. Unless we had a 100% tax rate, she really did want son to have the money. So there is something economically to it. But in slide 71, they both received a full deduction. Slide 72. Suppose instead of getting half of the business to the son, she gives half to the trust. So the trust takes this $200,000 of qualified business income and keeps the half and distributes the half. Now notice in slide 2, I imputed an evil purpose here. So this is an abuse of trust according to the regulations. I'm stipulating that. So look at the fourth bullet point. Her taxable income is $300,000. The trust taxable income is $100,000. Son's taxable income is $100,000. How does the anti-abuse rule work? So I asked for clarification, and here's the response I got back in our webinar. Mom is considered to have $500,000 of taxable income for purposes of the threshold because this was an abuse of trust. How about trust? Is trust considered to have $100,000 taxable income, $200,000 because you add son and trust together, or $400,000 because that's mom's and he viewed as one business. What's trust taxable income? The government wouldn't say. How about sons? Government wouldn't say. So we don't know the answer for the trust or the son. We only know the answer for mom. Slide 73, multiple trust rule. The proposed regulations had very confusing examples. Why were they confusing? Because the legislative history really mucks it up, makes it very confusing. AgTech asked a ton of questions, and basically we figured we knew what was going to happen, and what we thought would happen actually did. The IRS just said, I'm punting. They retreated back to the multiple trust rules under the statute and said, by regulation, we're implementing the multiple trust rules. Go look at the legislative history. Have a nice day. So slide 74, they said that they basically talked about that. But anyway, so slide 75, again, I have a link back to XX's comments. So this is going to basically, if you want to know what the multiple trust rules really mean, the AgTech comments can raise the various questions about what they really do mean. My view is that I've seen siblings fight with each other countless times. So I think we can easily, when we advise clients, we say, hey, you need separate trust for your kids so they don't fight. Okay? It may have a side effect that's beneficial for tax purposes, but we're not going to write anything like that in our notes. Our notes are going to just talk about that we want to avoid fights, and that's why we're creating the trust. And we might orally give them suggestions, but we're not going to do that in writing regarding the taxes. Anyway, so slide 77, there's a separate share rule, which I think is just pretty much common sense that they put in the proposed regs. Slide 78, share remainder trust, there's some rules there. I'm not going to spend time on those. That is it for those. So slide 79, again, I thank everybody for listening. I hope you enjoyed listening and found this informative. I do have a fiduciary income tax refresher for those who are interested in that. We have my blog where I have an occasional article, heckling reports, and then of course you should get my newsletter if you don't. July 23rd is going to be my next webinar. The other thing is that I'm looking into collaborating with Steve Leinberg with his services and providing webinars. I'm thinking about maybe doing like monthly webinars, and they charge a fee of like $160 a person for that. So I'm thinking about doing that. That would not replace my free quarterly webinars. I'm going to keep doing my quarterly ones, but this would just give you a chance to have a little bit more insight. If you have any comments on my doing that, then feel free to put that in your evaluations. So thank you for participating. Please complete and submit the survey located at the bottom in the widget at the bottom of your screen. And thank you for listening. Look forward to catching up with you next time.